The best opportunities we're seeing currently in a number of different areas. One, food retail, where we think the largest retailers like Tesco have fought back against the discounters. Secondly, in general retail, where we think the likelihood of the high street completely disintegrating has probably been taken to extremes. So we think some retailers will transfer their business onto online and also continue to do well in the high street. We also think there's opportunities in the banking sector and also opportunities for those companies exposed to repair, maintenance, improvement of the UK housing stock, which benefit from people doing up their houses, doing extensions and conversions. Yes, value traps are an important area to avoid, and we focus on the Ds. Is it dodgy management? Is there dodgy accounting? Is there disruption? And those sort of areas which suggest that the recovery might not be easy. And we're always looking at the balance sheet saying, can this company recover if it's got excessive debt? So those are the areas we're trying to avoid having too much exposure to. One of our most recent acquisitions has been Superdry, a brand that's lost its way, perhaps even over the last year or so, where the incumbent management has just left, the old management has returned, and we think they can reinvigorate the Superdry brand. One of the most recent sales has been Centrica, which we sold in the middle of last year. We're not convinced that management is completely understanding of the issues it's got. We think it's got a number of fires within the company to deal with, and it's struggling to put them out. We think that could put the dividend under pressure, and at the same time debt is at slightly uncomfortable levels. I guess our favourite holding is Capita, one of our biggest stocks. The reason we like it is because it's such an easy stock for other investors to hate. It's involved with outsourcing. All its revenues virtually in the UK economy. The UK government and local government are reasonably big customers. So you can understand why other investors are avoiding it. However, we think the company's been through a lot. New management arrived, and we think margins can expand from their current levels, and perhaps most importantly of all, we think their software business is very valuable. So if the recovery isn't as quick as we expect, we think that software business could be sold and would underpin the valuation of the whole group. We like the UK banks, and for a number of reasons. They're heavily regulated, their balance sheets are much stronger than they've been for many years, and we don't think, we think they've learnt the lessons of the financial crisis, so we don't think that's going to be the area to look for when there's another financial crisis. So what are we left with? We're left with companies which are earning good levels of profitability, which they will be able to pay out as good levels of dividends, and have got strong balance sheets, and we think that's a great combination.